Mortgage rates unfortunately just got crushed by the most recent jobs report, which in turn launched rates over 7% for the biggest one-day jump in over a year. So what does this mean for the housing market as we move into 2024? Are we still going to see rates pull back? What's going to happen with inventory? When is the Fed actually going to pivot? Well, that's exactly what we're going to talk about in today's video as we discuss the Fed, the economy, interest rates, as well as the housing market. But before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. And if you want to stay updated and support my goal of 100,000 subscribers, do me a favor and hit that subscribe button. The most recent report showed that the U.S. job market added 353,000 jobs in January, which was significantly better than the 185,000 that the Dow Jones was expecting. And because of that, the unemployment rate held at 3.7% versus the estimate of 3.8%. In addition to that, we got jobless claims falling to 218,000, which in turn shows that layoffs are still very, very low. So why is all of this actually important? Well, it's because the Fed has a dual mandate. One is full employment, with the second being keeping inflation under control. And with that, if you're just taking a bird's eye view, it looks like the Fed is doing their job because employment is staying strong and we're continuing to see inflation move lower towards the Fed's 2% target. So with the economy showing that the job market is still strong, with inflation continuing to move lower, it's more or less giving the Fed the green light to hold off from having to pivot, from having to do any rate cuts to bring down their super restrictive policy. Because at the moment, it looks like, hey, we've done our job. We raised the Fed funds rate from 0% to 5.5%, while at the same time bringing inflation down, and the job market hasn't broken. So in their mind, there's no need to do any change. There's no need to change what isn't broken, because at the end of the day, the last thing they want to do is start cutting rates and allow inflation to come back into play. And that's exactly why in the last meeting that the Fed held the rates steady, indicating that they're not ready to start cutting rates. And while they did change a lot of language in their Fed statement, they have more or less reaffirmed that a March rate cut is off the table. And if that wasn't enough, Fed Powell went a step further and actually went on 60 Minutes to talk about inflation, to talk about the economy, along with talking about how they're wary of cutting rates too soon. And while most people think of the Fed, they think of Fed Chair Powell, there are other voting members of the Fed that have a big impact when they come out and talk to the media. And one of those is Neel Kashkari, who's one of the more hawkish members of the Fed, who is currently backing sentiment that policymakers can actually take their time cutting rates, because his belief is that the Fed policy is not quite as restrictive on growth as it appears on the surface. Well, what does that actually mean? Well, restrictive policy means that the Fed's rates, if you will, is considerably higher than the current rate of inflation. So if inflation is currently sitting at 3% and you have the Fed funds rate at 5.5%, you in turn have a 2.5% rate, which is super restrictive when it comes out to what the Fed has said that they wanted over the last year. And here's the thing, inflation is going to continue to move lower. In fact, this week on Tuesday, we're going to get the latest CPI numbers, and it's going to show that inflation is continuing to moderate. And this month, we're actually replacing a really big number with likely a really small number. And the same thing is going to happen in February and in April. And there's a really good chance by the end of April, we're sitting with inflation in the low 2% range. And the Fed has said several times over the last year, they essentially want the real rates and inflation more or less moving in lockstep. And we're currently a long ways from that, because even if the Fed decided to come out tomorrow and cut 1.5%, that would bring us down to 4%, which is still 1% higher than our current rate of inflation as of today, which is still a very restrictive stance. And that's because the Fed typically waits too long to react. They did the same thing by keeping interest rates at 0 for too long. And now we're on the flip side of it, and they're going to keep interest rates too high for too long, which in turn is going to stall the economy. And the real reason I bring this up is because all of this stuff that we're talking about here creates volatility in the market. It creates volatility in interest rates. And my current belief is that you're not going to see a meaningful move in mortgage rates until the Fed actually starts to pivot, until they start to reduce rates, which at the moment looks like it's going to start sometime between May and June of 2024. But even with that, 2 to 3 rate cuts are more or less already built into the market. As you even have Kashkari, who we said is one of the more hawkish members, saying that 2 to 3 rate cuts are appropriate for 2024, which means in the interim, we probably bounce around somewhere between that 6 and 7% range when it comes to mortgage rates. That's unless we see something bigger happen in the commercial banking sector, like we saw last year with Silicon Valley Bank. Most recently, we've seen NYCB, which is another big bank in New York, starting to have problems. Their current issue is already starting to send some ripples through the market, which in turn could lead to more banks having the same issue. And we're likely to see more issues arrive due to the Bank Term Funding Program. Now, if you're not familiar with the BTFP, if you will, it was an emergency loan program that allowed banks and credit unions to borrow money for up to 1 year, pledging U.S. Treasuries and agency debt as collateral, which in turn became a short-term bailout for banks. Now, the whole thing was designed to stabilize the financial markets at that time and more or less prevent a collapse by offering these short-term loans that were struggling to obtain funding at that time. Well, did you know it actually expires on March 11th, which is 1 month away? Well, this is important because over the last year, banks have accessed $165 billion of free liquidity from the Fed and actually have another month to still do so. But here's the catch. With the liquidity terms of this agreement, the banks that borrowed that money actually have to pay back the Fed within a year. So while all of this funding more or less helped distressed banks by bailing them out, all it really did was kick the can further down the road, which more or less means if a bank was going to collapse last March, there's a really good chance once they pay this money back, if they can pay this money back, they're probably headed down the same road again, unless the Fed steps in. And the reason I bring up this is because I don't believe the economy is doing quite as well as some of the numbers out there support. Yeah, the jobs market looks strong, but we know a lot of that savings that was accrued during the pandemic that was saved, that's all gone for most people. In fact, credit card delinquencies surged in 2023. And that's because of all the buy now, pay later type of mentality out there. Hey, I want this. I'm going to put it on a credit card. Oh shit, it's due. I got to pay this. Oh, that's a problem. I don't have the money. Well, I personally believe you're going to see more and more of that over the next year, which in turn is going to lead to a softer economy and cause the Fed to have to readjust their outlook, not only on cutting rates, but how much they cut by. With interest rates currently sitting around 7%, that's causing housing affordability to remain near all-time lows, which is one of the problems for the housing market, but it's not the only problem because people are out there still buying homes. The other problem with the housing market is the lack of inventory out there to choose from. Typically, when you see a market like we're in right now with rising rates, you see more sellers come to the market because of distressed situations, because of a changing environment. But we all know many of these homeowners are sitting on super low rates. So putting their home on the market to sell it doesn't really benefit them in any way because in turn, they would have to go out and buy something else, likely at a higher price, with a higher mortgage rate, which means a higher monthly payment. And if that wasn't enough, mortgage holders actually gained $1.6 trillion in equity in 2023 to reach an all-time aggregate of $16 trillion, which is the highest year-end total on record. And 2/3 of that is held by borrowers with 760 credit scores. So when everybody out there talks about people losing their job, people defaulting on their homes, having to foreclose, understand how much equity is in these properties. And not only that, but the credit of the borrowers that actually own those loans. They have high credit scores. These people aren't likely to default on their mortgage. If anything, they would sell their home and it wouldn't be a distressed situation because of the amount of equity they have in that property. Actually, right now, the average mortgage holder has $299,000 of equity in their home, and $193,000 of that is actually tappable equity, which means if they pulled that money out, they would still have 20% in their home. And we know at the moment, most of these people aren't going to tap that equity because of where rates are. And on top of that, they're not likely to sell their homes either for that exact same reason, which means inventory is likely to stay low and in turn cause a housing market very similar to the one that we saw in 2023, which is less transactions actually taking place. Now, it's going to be higher than it was last year, but at the moment, it doesn't look like it's going to be significant unless we see that big change in mortgage rates. So if I'm a buyer out there, I'm a seller out there, I'm looking at the market right now. As a seller, it's a really good time to be a seller, but you also have to look at your position as a buyer. Are you able to find what you want? Are you okay with the rates? That's what you need to be thinking about. On the flip side, as a buyer, you need to be patient, but you also need to be ready. You need to have that pre-approval done. You need to be locked and loaded so when the right property does present itself, you're not waiting. Because if you're in a market and your price range is under the median price, chances are it's going to be a competitive market with multiple offers, and you're likely going to have to be aggressive when making those offers. But if you're in the luxury space, you're looking for a higher end property, there's less competition for those homes because there's just less able buyers to do it. But here's the thing, as rates change, the housing market is going to change with it. And I've talked a lot about that in my 2024 rate forecast. So if you want to know more information about rates, where they're headed, when that's likely to happen, do me a favor and check out this video here.